Good day, subscribers. Thank you so much for joining me today on the Financial Education Channel. I am Jeremy. This is the Financial Education Channel, and today we are talking about margin. What is margin? What is margin trading? What's a margin account? This can get very confusing for a lot of people, and many retail investors hear these terms used and they don't quite know what they mean. And they may hear them heard from their brokerage who might tell them, hey, you should open up a margin account, but you might not know exactly what that is. Today, I'm going to help you and answer so much about margin accounts. Hopefully, your information is like up here at the end of this video. So, in the most simple terms possible, a margin account is a stock trading account that you can go ahead and invest an extra dollar for every dollar you have. So you can basically create debt. So if you believe in a stock a lot and you have $100 in your account, you can invest an extra $100 into that stock, so you can have $200 actually invested in that stock, even though only $100 is yours. So a margin account allows you to be able to invest a lot more money than you have, basically. You're basically issuing debt. Now, the big problem that makes margin very scary is, say you have $100 and then you invest the other $100 in debt also in that stock. So you have $200 total invested, but only $100 is actually yours. The other 100 is just debt, excuse me. Let's say that stock went down 50%. So you would then lose all your money if that stock just went down 50%, because then it goes down to $100. But remember, the brokerage is the one that always gets their money first. So the brokerage gets their money first. So if there's only $100 left in there, that's their money at that point. You lost everything. You lost all your money. Whereas if you just invest in that stock regularly in a regular brokerage account and you didn't go on margin, you didn't take out debt, and you just did $100 in it, that stock would have to go down 100% for you to lose 100% of your money. If it went down 50%, you would still have $50 left. But you see, when you issued that debt, you invested with a lot more money. And of course, here's the other thing. What if that stock doubled? What if that stock went up 100%? Well, if you had your $100 invested in it and that's it, and you didn't have any margin, then you would have $200, right? Because you had $100, it doubled, now you have $200. But if you had $200 invested, so you had $100 of your own, $100 of debt, then now you have $400, but $300 of that dollars is yours. $300 of that dollars, because you only need to still pay back your $100 that you issued in debt. So you make a $200 profit versus just making a $100 profit if you had just invested in a regular brokerage and you didn't take out any debt. So that is the power of margin. You can make so much more money investing on margin if you are picking the right stocks and doing the right things and everything's going your way. You can just rack up money. But on the downside, if stocks start going bad, you pick a bad name to go into, you can get hammered. You can get absolutely hammered and lose everything, even without that stock losing all its money, just because you can't pay the debt. And you get what's called margin calls coming after you, which a margin call is issued when a stock goes down too far. And that you need to read the guidelines on if you ever do open up a margin account, because every brokerage is different. But if basically a stock gets too low in its price, where it puts the banks, I don't call it the bank, the financial institutions' money at risk, or whatever they feel is at risk, they can issue a margin call and say, hey, you need to come up with $500 or $1,000 and you need to put that in your account by 3 days from now, or we're going to sell all your shares for you. Imagine that. Imagine being down 20-30% on a stock and oh, this stock doesn't belong trading here. It should be much higher than it is. And you get a margin call and you don't have that $500 or $1,000 or whatever amount of money to put in your account right then and there, and they just go ahead and sell all your shares. Imagine that, and you lose so much money, because if it went down 20% and you were investing on margin 100%, then you lost actually 40%. not just 20%. So that hurts. So that is a big danger about margin. Now, a reason why a margin account is good is if you never touch the margin. But here's why it's good. A regular brokerage account, you can't do day trading. The reason being, trades need 3 days to close. If you're a day trader, you're trading in and out of stocks, it's going to create a balance left over from that previous stock. So you're not allowed to basically invest it again in another stock, because then that stock needs to close 3 days and whatnot. So you're basically making the financial institution come up with that money in the midterm so you can perform your trade and trade and trade and trade, because it takes 3 days for the trades to close out. So you're just creating a big thing for them to keep, basically dishing out money, because that money's still in that stock technically until it's closed out, which takes 3 business days. But a margin account allows you to skip all that, because a margin account, you can trade and then you can be on margin, but you're not on margin as long as you're not investing more than what your account has. Because once that 3 days comes by, it's going to close out completely. So that's a huge advantage of a margin account. If you're someone that likes to day trade, if you're a trader, you pretty much have to have a margin account. You have to. There's no other way around it. So that's what would be considered margin trading. So if you ever hear someone saying margin trading, that's probably what they mean. They mean you're doing day trading. So you have money in that balance there. Now, on a margin account, not only do you risk losing all your money based upon just much smaller losses in the stock, but you also have to pay interest on whatever money you loan out. And the amount of interest you pay out depends on how much you take out for a loan and how much you have in your account balance. So you can pay 7, 8, 9% on the margin money per year. So let's say you take out $100,000, you have $100,000 and then you take out $100,000 to also invest in margin debt. So on that $100,000, if you're paying a 9% rate, you're going to pay $9,000 to that financial institution of your own money just to have that margin. So you need to make at least a 9% return just to cover it. So in margin trading, you have to be extremely confident that you can make very high gains as a percent. Otherwise, you're going to get wiped out. And then obviously, I talked about it, if you go too heavy in a stock and that stock goes down, next thing you know, you have margin calls. Then not only do you have margin calls, but then you need to pay your balance off every month of interest, which is 7, 8, 9%, whatever you're paying, somewhere around there. It's generally between 7 and 9. So you can get hammered. I know from experience, I've been hammered there. I've tried the margin because I've been super successful with stocks. So I thought, let me invest a little more. And it is something to be very scared about. And if you do it, be very aware of what I'm telling you, because it's going to matter a lot. And everybody gets to that mode where they're like really cocky about it. Like, no, I can do it. I can invest on margin. And then sometimes it doesn't work out, and it's really unfortunate. Anyways, I hope that explained perfectly what margin trading is, what a margin account is, what margin is at the end of the day. And thank you so much for watching, as always, guys. If you haven't subscribed, you may want to. I talk a ton about stocks and things like that related to today's video. Talk about personal finance. And I also talk about business and being a young entrepreneur, being an entrepreneur in general. So I thank you so much for watching, guys, and have a great day.